Thing on my mind, gotta hustle and grind. Financial literacy always on my mind. I'm stacking knowledge, no time to waste. Gotta invest smart, gotta keep up the pace. I'm reading books, learning all the tricks, studying the market, making calculated picks.
What's good, everybody? It's your boy Reckless Ray Dinero, and we are back at it again with another episode of Future Financial Strategies, rolling into Bag Fortification Friday. It is Thursday. I'm hoping you guys are having a good week. If not, there's still a few days left where we can change that and turn that around. First and foremost, let's make sure we hit that like button on the way in the door. This is your reminder. Hit the like button. If you've been here more than twice, definitely hit that subscribe button down below. Also, do not forget to share this with people that you care about, maybe even people that you don't care about, because maybe the people that you don't care about, they're just annoying you because they're broke. So we're not trying to get rich over here by ourselves in the Wolfpack. There's always room for more people to join the movement, to tap in and start making those adjustments. So if you're getting value out of this, you should assume that somebody else will get value out of this. Share the video. We're going to talk today about how I go about using margin, because I've had a few different conversations and I've been obviously trolling through the subreddits. I've seen some people asking some random questions about margin. So I'm just going to break it down from my perspective, how I use it and my philosophy and thoughts on it. So first and foremost, margin is actually borrowing, leveraging your brokerage account. High risk play, obviously, because you're borrowing against the stocks in your brokerage account. So if you have a highly volatile account, similar to what I have with my high yield income account, which is the majority of my account, also my long-term holdings are pretty volatile. So I don't even have margin in that account, because that's an account that if I'm going to borrow and risk the biscuit, I'll risk out of the income account. I do not risk out of my long-term account at this juncture, but I digress. You're borrowing against the funds that you have. So any fluctuation in those funds affects your margin. So for instance, if say I've got $20,000 in margin in my income account that I have access to, and I borrow all $20,000. And then, say, for instance, hypothetical, something that actually we've all experienced here recently, the market goes down 30%. And you're 100% leveraged. Now you're going to be forced to sell. That's what happens if you get called on your margin account, which basically they go, hey, we need our money back to an acceptable level. You got to sell some of your assets off immediately to give us our money back, or deposit money into the account. That's a terrible worst case scenario. And it's one of the scenarios, actually, it's the only scenario that people will tell you when they tell you that, oh, you can't do margin. It's dangerous. It's risky. It's, oh my God, it's the worst. You just can't do it. Margin's the worst. It's because they don't know how to use the tool. It's the same people who say no one should have credit cards. Credit cards are the worst. They're terrible. They just don't know how to use it. Like, they shouldn't have credit cards, which is fair. Credit cards are not for everybody. Margin is not for everybody. And I can be straightforward with that. Like, if it's not for you and you believe that nobody should have margin, you probably shouldn't have margin. If you believe that nobody should have credit cards, credit's terrible, you probably shouldn't have credit. That's fine. Buy everything in cash yourself. Like, I hope you're invested in Bitcoin, because that's the only way that's going to be possible. But like, maybe, whatever, do you. Awesome. So that's the caveat. We're covered on the worst case scenario for margin, which is you get margin called, you have to force liquidate your portfolio gets nuked. If you can't afford the maintenance, and now your portfolio is terrible, you don't have as many assets as you thought you were going to have, the market didn't go your way, you placed a bet and lost. Now, the way that I use it pretty strategically. Like, at most points in time, my account sits, as far as the cash balance goes, it's a little bit in the negative, like most of the time, because I'm not always, but I am at times tapped on margin. Now, when stuff is going up, like, unless I'm trying to get over a hump to get whatever metric I'm trying to hit, and I'm feeling antsy or rushing or feeling like an opportunity is going to be passing me by, I don't generally I don't use my margin. So a lot of the time when I'm deploying margin, it's going to be, if I'm going to pay interest, it's going to be when the market is down. So when we hit that 30%, that's when I actually started using margin. Like when we had that market downturn, that's when I started deploying margin, because I am in the understanding of the space that I'm in. So when the market downturns, I'm like, okay, so we took a 30% hit. Probabilistically, I don't believe we're taking another 30% hit. So while this may go down, if I start dollar cost averaging now, we're already down 30%. I'm like, this phase in the market for Bitcoin, I'm like, we could see like maybe another 10 to 20%. Fair. I'll dollar cost average that down. So I started dollar cost averaging with margin. So I was buying big chunks to buy my averages down, and it worked out. So that's cool. And we paid the margin back, and like now we're kind of slow. We're at the tail end of the dip, and we're kind of on the upswing, but we're still under my cost basis on Misty. So I'm still using a little bit of margin to get my buys in early. And then when we get our payment back, we'll pay the margin back, and then whatever's left over, because we're using for investment now, like I'm prepaying myself, everything that's left over will go into elimination of debt. That's awesome. What are the costs of margins? So at Charles Schwab, it's like 12%. Over at Robinhood, since I'm a gold member, it's like 5%. So I have a better deal on margin over in Robinhood. So we might be doing a little bit of margin arbitrage, if you would, with those accounts as the Robinhood account grows. I'm not sure how I want to utilize that. I mean, obviously, like it's not that big a deal to cycle between the accounts, but again, like my Robinhood account is going to be a little bit more stable, so I should have access to a little bit more margin over there once it gets up into the levels that we are at in the Charles Schwab account. That said, I'm pretty excited about most of the stuff that we've got going on. We've got a good margin pool in Charles Schwab. We've got a good margin pool in Robinhood. And, being able to balance those percentages, pretty cool. One of the other things that is pretty interesting about margin is you don't necessarily have to use it for stock investing. Like both Robinhood and Charles Schwab allow you to withdraw your account into the negative, to pull cash out into your bank account, to draw on your margin. So like it's actually an additional lower interest line of credit, because I don't know a credit card that is 12%, to be honest. I definitely have never seen a credit card that gave you 5% interest ever in my existence since I've been alive. So that's another ability. So like as far as like debt consolidation, you could draw it into the margin account. Like for those people who like to have something that's semi set and forget, one of the plays that you could do is you pull your margin out, pay off all your high interest credit cards, move it into your margin, and then just let your high yield dividends just pay it back every month until it's paid back. That's also something that you could do. It's something that I'm looking at doing. Currently everything's sitting at 0%, so there's no benefit in doing that at this juncture, because we're kind of on our trajectory to pay stuff off. We've got a plan in place. The debt is getting chunked down. But that was something that I was looking at for a while, because I didn't want to liquidate my account, because then I lose the stock and the positions. We had to do a few sales, not really liking it, but we did it. And the ability with my traditional finance portfolio to actually just move it into the margin, if I was in a scenario where that was going to be a strategic play, and just let it auto pay down every month when that Misty payment hits and just chunk it down like that, is awesome. Your margin also doesn't show up on your credit report. It's another really cool thing about margin. So now, you can fix or make your credit numbers look better as you're transitioning over, which is pretty cool. I think that's kind of a great thing. Margin's a good tool. And so how do I personally use it? I set limits for myself. I never go over 50% of my margin. And the reason being is the whole name of the game with margin for me is to not get margin called. I'm not degenerately gambling. I'm placing bets on things that I believe in and I'm buying long term. So I've used margin to buy MicroStrategy, MSTR. I've used margin to buy Misty. Those are pretty much the things I use margin to buy. Over in my Robinhood portfolio, I'm using margin to buy LFG. Actually, everything in that portfolio, I've bought a few shares in margin, but all of those things are long-term holdings. Like the whole play on that portfolio is to be able to repay that Robinhood Gold card. So we're building up an account to basically fund incidentals, my daily driver card, and we're going to transition over to the Robinhood Gold credit card for the daily driver because, in my opinion, I think it's one of the best credit cards ever made. Like, it's been made specifically for people like me who are a little bit I'd say financially savvy, financially literate. It's tied to a platform where there's a bunch of plays that you can make to make the card self-funding. So at that point, it's almost like having free money. It's passive income, a good way to tap your passive income. And I'm going to have a card that's going to be based on passive income, which is cool. It'll pay for the credit card, pay the bills, which that's the goal. So I never go over 50%. Usually, like if you want to stay in the safety range, like very safe, don't go over 30%. A lot of times I'm under 30%. But it's being able to have control of yourself, because when you look and you go, hey, I've got access to 18, 10,000, 15,000, 25,000, depending on the size of your portfolio, $50,000 to $100,000. It's easy to just ape into stuff. Next thing you know, market doesn't go your way and you're getting called. So the name of the game for me is to not get margin called, which so far I have done very well at. I have also, the account that I use the majority of my margin in, which is my Charles Schwab. Also, I have direct deposits. I have cash going in there all the time to help mitigate those margin positions because I'm constantly chunking at it. But that's how I leverage my portfolio. And that's just what I'm doing with my money. I don't like losing money and I don't like giving up assets. So for me, margin is an ability, especially with these high yield incomes, to front run my payments, which is historically what I had been using it for. It's also an ability to transition higher interest debt into a lower interest debt and then pay it down fast. So as we're getting to the point to where we're paying these credit cards down faster, as opposed to like when I'm in striking range of like a payoff, I can pull that out of the margin, have it come out of the margin, get it into my checking account, get that card paid off. Now that interest is transitioned over into a high yield account. And then when those dividend checks come in, I can just pay it off that way. That's how I'm strategically using it right now. Moving forward, once the debt's eliminated, we'll just be using it to, bolster the coffers. It's like, hey, we got a new position coming in. We can go ahead and prepay it, get a good chunk of it going, and then have it pay itself back, because the next thing that we'll be adding back into the income portfolio over on Schwab is weekly payers. So I've got that going. I will be adding another monthly payer, IMST, which is going to be another big chunk payer for Misty. We'll be doing that. And we'll be doing some weeklies because I want some weekly income in there. We'll be bringing LFGY back into the fold. That's what I'm going to use. It's been solid, been good. Might also do YBTC. That's another option. Might do both. I've been liking both. They both pay on Friday. Get yourself a nice little Friday payment going. to kind of fill in the gaps. But IMST is probably, honestly, IMST is going to be the next addition into that portfolio. And that will probably be started with we'll be taking a chunk of margin and just being like, hey, cool, throw it in there. Let's see what we can do. Because we know on the back end, it's going to get paid back because we already have a big payer in there. We have a good amount of Misty. So having a good amount of Misty, using that margin to build up once the debt's paid off the next position just makes sense. We'll be doing that with the pay that we're getting every week too, but that's one of the perks and how I break down and use margin for myself. Now, there's a bazillion different margin strategies. I just don't like the risk of losing money or the potential to get margin called in that sense. So I'm very cognizant as I grow my portfolio to keep it within a metric to where like this portfolio basically has to go to zero and something's wrong in the economy and for everyone else. And now it's not necessarily that I needed stocks. I needed guns and ammo. And like, that's a different problem before I get margin called. So like if I'm getting margin called, the economy is destroyed. That's the way that I feel. And so like, I like to be in the safety zone with margin. Like it's a tool. And like all other tools that we talk about, we do not get emotionally attached to the tool. Use the tool for what it's for and use it appropriately. And that's what I got today. This isn't going to be a super long one. I don't need to drag it out. That's kind of to the point. That's how I use margin, what I think about it. Let me know if you guys are using margin, if you're considering using margin, down in the comments and what you think about it. Till next week, people, this has been another episode of Future Financial Strategies. Thanks for hanging out with me. Final reminder, if you made it this far in the video, hit that like button. Second reminder, if you've been here more than twice, definitely touch that subscribe. And third reminder, if you made it this far in the video and you got value out of this, make sure to share it with your communities and your people, because over here in the Wolfpack, we always have room for more and we're not trying to get rich by ourselves. Till next week, folks, it's your boy Reckless Ray Arrow, and we are out.
Money on my mind, yeah. Focus, got no time for games, nah. I don't blame it, I'm all about that financial literacy. Investing in my future, building generational wealth. Dollar bills, they be calling my name, but I ain't chasing fame, I'm chasing change. Learn the game, now I'm playing it smart. Putting my money to work, it's an art. I'm stacking paper, building my own empire. No more living check to check, I'm getting higher. Investing in stocks, real estate, and more. Gotta secure the bag, that's what I came for.